gold is going to act favorably to inflation, but if the Fed is not cutting rates, you don't get that additional kind of a boost. And so they don't cancel each other out, but the item that has the strength is going to be the way of the prevailing winds, let's say. And I think that we might see, if we had to tone down my forecast, I still think it's going to easily hit 3,000 and possibly challenge 3,100 in a more challenging environment. In a more favorable environment for gold, it would barrel through 3,000 and not only challenge 3,100, but go in excess, 3,150, shy of 3,200 per ounce.
In a comprehensive analysis of the gold market, veteran technical analyst Gary Wagner offers an optimistic outlook despite acknowledging potential market challenges. Wagner envisions gold reaching $3,000 per ounce, with the possibility of testing higher levels of up to $3,100. His analysis suggests that under more favorable market conditions, the precious metal could surpass these targets, potentially approaching the $3,200 mark. Wagner's assessment aligns with projections from major financial institutions. Leading investment banks have presented similarly bullish forecasts for 2025, with JP Morgan predicting $3,100 per ounce, Goldman Sachs initially targeting $3,150, and Morgan Stanley setting the highest projection at $3,200. These consistent forecasts from major financial players suggest a strong consensus regarding gold's upward potential. As analyzed by Wagner, a historical perspective of gold's performance from 2019 through early 2024 reveals a market characterized by significant volatility. The precious metal experienced notable corrections and eventually found stability around the $2,200 level until February 2024. Subsequently, the market witnessed substantial gains, pushing gold to unprecedented highs near $2,880, primarily driven by a weakening US dollar, declining yields across the curve, and increased haven demand stemming from tariff concerns. However, the market's volatile nature became evident by the end of March 2024, when gold experienced its most severe quarterly decline since Q4 2016, dropping over 10% year-to-date. This significant correction, placing gold 18% below its August 2020 record of $2,067, exemplifies the metal's susceptibility to broader currency market movements. These market dynamics present a complex picture where bullish projections and market realities coexist, suggesting that while the path to $3,000 and beyond may be achievable, it likely will involve significant market fluctuations and challenges along the way. Before diving deep into this video, subscribe to our channel and hit the bell icon so you never miss an update. Doing so lets you stay informed about our latest videos, market insights, and expert analysis.
This is a basic area chart. It's a line chart drawn with weekly data. We're going back to about 2019. I really want to focus in on the point. I believe it's right around here where we're 19, about $2,000. That is the end of December 2019. It then moves up as high as 2,300. And during this period, you're actually getting respectable corrections. In other words, from 2,385 here down to about $2,000 in March of 21. It moves back up, but it is a lower high than the previous high, and then another deep correction. And then you get a lower high, but you get kind of a plateau at around 2,200. Which takes us up to February of 2024, the real low coming in October 2023, and that is this dip here, because this is when I believe everything changed. We had the geopolitical environment got really hectic. We saw gold rise from $2,000, and within about a 4 to 5 month period of time, rise to 2,500. But the point that I'm trying to make is that if you look at the retracement from, call it, I'm going to round down, but a 2250 down to 2000 is about a $250 correction. And you look at the correction, compare that to 2250 down to 2170. These corrections got much shallower. And so once we saw gold ramp up, and this, of course, is the record high above 2,800, that's really the only time recently, and when I say recently, I mean within the last year, where we've seen a respectable correction. A market that is overheating and moves up either parabolic or exceedingly quickly tends to come down just as fast. Parabolic up, parabolic down. And so we did see a sell-off, but the most impressive part is really what happened during the last week of December up to current pricing, because we're literally looking at a month in time in which we saw gold gain tremendous value. And that's just an area chart. We can really see what happened today. This week was phenomenal, by the way, because we had the sell-off that occurred on Monday, I think a $44 sell-off, and then today's tremendous rise, moving above recent tops. And so in terms of analyzing the marketplace itself, it gets to be very difficult to analyze how high a market could go when we're at all-time record highs. So I'm just trying to get a sense of the moves we've seen recently, and I've broken it down into a series of two rallies. I'm using Elliott Wave to accomplish that, but what I'm looking at is from October of 23, gold is sitting just at around 2,000. It runs up approximately $500, a 27% rise, and it did that in 230 days. And then corrected, we had a second leg of the rally, and on this rally, it took 122 days, and it increased at about $454. I simply averaged out these price moves, and then from the beginning of this current leg of the rally, I've done what's basically called a Fibonacci extension, which is how I have derived my projection. And this is for the first half to the third quarter of this year, and that is to see gold move substantially higher, well above 3,000, and actually breach $3,100. That is my current assessment of an interim forecast for gold, David.
Gary Wagner offers valuable insights into the intricate relationship between gold prices and economic factors, particularly emphasizing the precious metals' response to inflation and monetary policy. According to Wagner, gold demonstrates particular strength during periods of elevated inflation, significantly when inflation rates exceed levels that make the public uncomfortable. He suggests that gold can maintain its upward trajectory even if the Federal Reserve implements a pause in rate cuts, as long as inflation persists. The historical relationship between gold and inflation underscores its reputation as a hedge against economic uncertainty. As a tangible asset, gold has consistently demonstrated its ability to preserve wealth over extended periods. This characteristic becomes particularly attractive to investors during inflationary periods as they seek to protect their purchasing power by shifting investments toward assets that traditionally maintain value despite economic pressures. The interplay between interest rates and gold prices has been particularly evident in 2024, with gold posting impressive gains exceeding 30%. However, Wagner and other analysts emphasize that the relationship isn't straightforward. While declining interest rates typically provide favorable conditions for gold appreciation, the impact can be neutralized by simultaneously decreasing inflation rates. This complex dynamic highlights that while lower interest rates create a positive environment for gold, investors must consider multiple economic variables when evaluating gold's potential performance. Let's get back to the video.
When we look at the price of gold and we look at the dollar, is that gold favors high inflation. I mean, it thrives in an environment in which inflation is rising or is at above a level that people are comfortable with. And so that if the Fed paused, because when the Fed cuts rates, that's also favorable for gold, but you get this push-pull effect where gold is going to act favorably to inflation, but if the Fed is not cutting rates, you don't get that additional kind of a boost. And so they don't cancel each other out, but the item that has the strength is going to be the way of the prevailing winds, let's say. And I think that we might see, if we had to tone down my forecast, I still think it's going to easily hit 3,000 and possibly challenge 3,100 in a more challenging environment. In a more favorable environment for gold, it would barrel through 3,000 and not only challenge 3,100, but go in excess, 3,150, shy of 3,200 per ounce. Inflation spiraling in a way that it did in 2020, 21. I'm not saying go back to 9%, but right now the Fed has been working to take inflation to a trajectory of 2%. It kind of settled down at around 3%. but it's been decreasing, but at a slower pace, with some particular items being the cause of it, being why we're seeing overall inflation being sticky, energy being a huge component, housing being another one. And so that if we see inflation begin to accelerate at a faster pace, if we see it move back substantially and increase by 0.5%, if it starts to go 3.5, and a trajectory is perceived that it could be going higher than even that, that would move the needle quicker. Let's look at recent activity where, well, what's going on in Russia and Ukraine is still elevated with not major changes, but in Israel, there was not a peace accord, but they had a truce. You've got the Palestinians moving back north. There has been, and there's been the return of hostages. So we have seen a de-escalation of the geopolitical conflict in the Middle East. And then if you look at the price of gold, you can see that it didn't apply a lot of bearish pressure, curtailing the upward move. If it would have, I don't think we would have seen gold spike as aggressively as it did. So if we get some resolution of conflict, which we all hope will happen, I think that the net effect to the rise of gold will be much more tempered because of the other conditions moving forward, which is the economic challenges, the inflation that seems to be persistent, and if heavy-handed tariffs are actually implemented, could begin to accelerate. So you're going to have these different factors and events kind of grinding against each other, and the squeaky wheel, let's say, will get the grease. So whatever is most prevalent and pressing on the minds, shaping market sentiment, will be the one that pushes the market the most, whether it's curtailing the bullish move, moving it from bullish to bearish, which I don't believe will happen, or accelerating the bullish rise of gold.
Gold stands as a trusted asset, particularly in times of economic uncertainty, offering protection against the erosion of purchasing power. Its value tends to rise when inflation increases and benefits from lower interest rates. However, its growth can be tempered by slower inflationary declines. In a fluctuating economic landscape, gold provides stability and security for investors seeking to preserve wealth, with its price movements reflecting broader financial conditions. What do you think about gold's performance in today's economic landscape? Share your thoughts in the comments below. Remember to like, comment, and subscribe for more updates if you found this video helpful. Thanks for watching.